Meet Alan and Sarah. Alan is 51 years old and the Chief Operating Officer for a Fortune 500 communications company. Sarah is 49 years old and a stay-at-home mother. They have 3 daughters, Melissa, 17, Denise, 15, and Rachel, 12. They live in Washington, D.C. Alan's income is $750,000 base compensation each year, and his bonuses average around $400,000 per year. He also participates in a deferred compensation program, deferring $200,000 of his bonus each year. They have a sizable amount of assets, including their current investment portfolio, which is made up of $7 million in taxable accounts, $3 million of which is sitting in money market funds, $3 million in 401ks and IRAs, $2 million in deferred compensation plans, $3 million in stock options, and $2 million in restricted stock, for a total of $17 million in investable assets. They own their home in Washington, D.C., which is valued at $2 million. They have $700,000 left on their primary mortgage. The mortgage rate is 4.5%, but they're wondering if they should just pay it off. They also own 2 other properties, a condo in Hawaii valued at $750,000 and a house in Italy valued at $1.5 million. They do not have any long-term care insurance, but they do have life insurance. Alan has a $3 million level term policy with 10 years left. Sarah has a $2 million level term policy with 10 years left as well. They have already put away $250,000 for each child in 529 college savings plans, so college funding is taken care of. They have estate planning documents, but they need to be updated as tax laws have changed since they were last looked at 5 years ago. They're not so happy with their current investment broker, who doesn't seem to understand their entire financial picture. They want to make sure that their assets are allocated properly and estate plan is updated and implemented correctly so that potential estate taxes are minimized. Alan would like to retire in 5 years. Are they on track for a comfortable retirement if he retires at 56? They spend around $500,000 per year and would like to make sure that they don't run out of money. They realize that they need an emergency fund, but feel that $3 million is too much to be keeping in cash. Where would it be better invested? They also would like to look into setting up a foundation to support their charitable desires. They would like a plan for exercising stock options and selling off restricted stock. They worry that they're too concentrated in Alan's company. They wonder if their insurance coverage is enough. They are especially concerned about long-term care, life insurance, and property and casualty. Do they have enough to protect themselves from getting sued? Can they do anything to reduce their income taxes now? They're also fairly laid back and are looking to simplify their financial life as much as possible. First and foremost, Ivy League worked with Alan and Sarah to develop a comprehensive financial plan, especially focusing on their current cash flows and funding for their various goals. The plan emphasized different retirement scenarios and looked at ways to make tax-efficient withdrawals in retirement to support their lifestyle. From this comprehensive plan, we were able to address Alan and Sarah's various concerns. We worked with their accountant to map out strategies for exercising options and selling off restricted stock to minimize their taxes. We set up a community foundation as a simple way to support their charitable desires. We analyzed the pros and cons of paying off their mortgage, but recommended against it because they would lose the tax deduction. To prepare for Alan's retirement, we had to address multiple aspects of their financial life. We determined the chances of them having enough resources to support their retirement given their high-spending lifestyle. We examined Alan's employer's retirement plans and integrated those with their retirement and non-retirement savings for asset allocation purposes. We made sure they were maxing out on their retirement savings to reduce their tax liability. In this case, we recommended increasing their contributions to the deferred compensation program. We developed and implemented a diversified asset allocation plan which supported their overall financial planning goals. We worked with respected insurance professionals to review their life insurance and property and casualty coverages. We also helped them to purchase extensive long-term care policies as well, and also increasing their umbrella coverages to provide additional liability insurance. And lastly, we went with them to work with an estate planning attorney to execute appropriate documents. For Alan and Sarah, this included updating their documents to include pour-over wills and revocable trusts, durable powers of attorney, and advanced medical directives. We also discussed using life insurance in an irrevocable life insurance trust as a means to pay estate taxes. We then implemented the estate plan by retitling the accounts and changing the beneficiary designation of their retirement savings accounts and life insurance policies. Alan and Sarah now have peace of mind over their financial life and can rest easy knowing that their investments are properly managed. They're on track to a secure retirement. They have adequate risk protection, and they're addressing their charitable desires in an easy and fulfilling manner. They couldn't have done it without a step-by-step plan from Ivy League financial advisors.